It seems super safe, right? And it is. It can be safe. And that's the thing I like about it. It's a leveraged product that you can make a lot of money and lose a lot of money, but because it doesn't require as much capital up front, if you learn to do it right, it actually can be safe.
Yeah. It seems like a sure thing.
And that's what I like to hear. I like to teach people who are very new to it and they walk away saying it seems like a sure thing. So
It's a no-brainer.
it's a no-brainer.
Welcome back to Options with the Boys. Welcome back. We trade QQ and sometimes SPY. We aim for the moon, but don't ask us why. SPX2, it's big and it's fast. We place our trades, then pray they last. We talk like we know what theta means, while eating cold wings and counting our greens. Delta, gamma, they're part of the lore. We nod real slow, then Google some more. Buy the dip, sell the rip, miss the top, then double dip. Sometimes we hedge, most times we don't. Say we'll cut losses, but we won't. No suits, no rules, no Bloomberg noise. Just half-baked trades and regular boys.
I need a football analogy.
Thank you. Yeah, that's what I've been waiting for. So are you familiar with the A11 strategy?
Yeah.
Okay.
Okay. So can you talk about the A11 just for a second? Just give the thesis of the A11.
Yeah, A11 essentially is you can have it's been outlawed, but I think it existed in California and maybe Texas. But essentially, on any normal offensive formation, you have to have 5 ineligible numbers on the field counted as linemen. The exception for that rule, when you have the ball, is when you're in a punt formation, right? Because then you don't have to have linemen on the field. So if you line the quarterback up 7 yards behind the ball, it becomes a punt formation at that point, legally, or according to the rules. And so then what guys would do is, fine, we'll have 11 athletes on the field, no linemen, and then you can line in crazy formations, and no one knows who is eligible and who is ineligible because they run up to the ball and then they quickly snap it. So it just made things almost very unpredictable for the defense.
So that's options.
Fantastic. It is the ultimate scheme, is what you're saying.
I want to be careful what we're saying. It is
That you're right. You're absolutely right.
It is the ultimate schematic. Now understand what I'm saying when I say that.
Definitely.
Okay.
Yeah, I get it.
All right.
We're on the same page.
Yeah, go ahead and ask your question.
My first question is, how many millions of dollars am I going to make in the first week?
That's a great question, Donnie.
Have any of you ever bought a stock?
No.
Okay. It's going to be interesting to see who picks this up like the best out of the person who gambles versus the person who's bought stock. I have a feeling the gambling might have an edge a little bit on this, but we'll see.
I hope
So when you bought a stock, David, you have bought and sold stocks trading the stock market, like you day trading.
Yes.
Jeremy, did you day trade or did you buy and hold?
You would say that, let's see, I signed up for a Robinhood account and they gave me a free stock. And that stock was for Sirius XM. And that was probably over 10 to 15 years ago. And I haven't touched it since. So I guess you could say I have diamond hands.
So we're going to have to, we will have to beat that out of you. Like, You want really soft hands. You want.
I have a question.
Good. Thank you. Please.
What are diamond hands?
Great question. I'm gonna actually I think from a Socrates type of learning environment, I think it'd be best for Jeremy to answer that.
Diamond hands is when you buy something, a stock or a crypto or an option, which wouldn't be good to have diamond hands. And no matter if it's up or down, you're going to hold on to it no matter what.
Who's the master in this situation?
You have
Did I teach? I didn't say that. Like, I'm not the master. You know, reference.
No, it was all during the stonks, GameStop.
Sure.
Stuff.
Okay.
You're reading
Okay.
a lot of Wall Street bets.
Okay. I got
And
you.
you would send me the memes and stuff, and diamond hands came up then.
Gotcha.
And I think it came up also during some crypto stuff.
Yeah.
That's-
So those.
Yeah.
Those are synonymous for, so you can do diamond hands or you can do hodl, which is hodl, HODL. Hodl. Hold on for dear life. Is another one.
Okay. Diamond hands makes you sound a lot cooler, though.
For sure.
It also sounds so boring.
I think it makes it sound like you have like real inner strength. Not boring.
How did that serious stock gift, like, if you had to look at, do you know what you're up on?
When it was given to me, it was worth about $5. And now, it's up to 21.78. So is that a 400% increase?
Yeah. Because you didn't even buy it.
That's true. That's
An extra 100% right there.
yeah,
You can go see a movie with that.
that's
For
right.
sure. Okay. So here's the deal. This is what we're going to do. So basically, my thing tonight is we're going to talk about Delta. And then we're going to talk about what the options market is. And if we could cover those two things, I think we've made like really good progress. And my thought is the following week, we'll talk about the mathematics of options. It's not going to be as boring as it sounds. It'll be really cool. You're going to think it's really cool. And then by week 3, I think you'll be ready to be considered like an options master if we do this right. But we have some work around. So here's the thing. When you buy a stock, these dumb questions, but let's say Apple, I think Apple's around $200 right now, but let's say Apple's $100. Okay. Let's say you buy 100 shares of Apple. So Apple's $100 and you buy 100 shares. How much money have you put into Apple? Apple's $100.
Oh, Apple's 100. Okay, I got you. And I bought 100 shares.
And you buy 100 shares. How much?
Was that 10,000?
Oh,
Okay.
10,000. So you've paid $10,000 for 100 shares. Okay, cool. So theoretically, you could lose $10,000, right? It would have to go to
zero.
if Apple just goes bankrupt. You've gone to zero. So now let's go the other direction. Apple's $100 and it goes to $101. How much money have you made?
I think you made $100.
You've made $100. So really what you're doing.
Yeah, that's what I said, 100.
So Jeremy was right and David was second. So you make basically every dollar that Apple goes up, you make $1 per share, right?
1 to 1.
I'm going to hit this hard because this is actually, I feel like if you can get this part, it actually is really important for understanding what it is. So you buy 100 shares of Apple, it goes up, it goes down, but you're never, if it goes up $10, you've made $1,000, right? Under this guy's 100 shares goes up $10, you made $1,000. The only way that you will double your money, the only way to do that is if you either hold it to when it gets to $200, or you are really good at scalping. Scalping meaning you basically sell it every time it goes up and buy it every time it goes down over and over and over again, which is what stock trading is, day trading.
I've been trying to do. I didn't realize that was the term, and I can't sustain it.
It's very difficult because it requires you to be really right about the market. And the reason it requires you to be really right about the market is because that's the only direction you go. Those are the only options you have when you buy stock. As it goes up, goes down, that's it. Whether you hold it forever, and people have different philosophies. They're like, you just hold it forever. That's why it works. That's why 401ks grow. I'm like, great, that's true. Also, there's multimillionaires who are really good at doing that thing of buying Apple when it's down, selling Apple when it's at the top. But to the question, so stocks, they go up, they go down. There's everything's static. You know what I'm saying? It's a 1-to-1. There's no exponential thing. If the best thing that could ever happen to you is if Apple went to $500 in one day, what's not going to do that? It might go to $500 in 3 years or 4 years, but it's not doing that overnight. But here's the main thing. This is like step one in your options education. When you're buying shares of Apple or a stock, you buy Apple, back to the Apple thing. You buy Apple, but what are you buying when you're buying shares of Apple? You're not really buying, you are buying shares, but this is how I think the first step to think about options is. You're actually buying what's called deltas. Have you ever heard of the concept of delta?
Not high school.
I read.
Mhm. So what is deltas? Delta is it's a options Greek. And you're like, this is way too fast, but this will be important. We're not going to talk about the other Greeks. It's just, this will help you. When you're buying a share, you're buying a delta, and each dollar that it moves is a delta. So what do I mean by that? Basically, a delta indicates how much an options price is expected to change for every dollar movement in the underlying price. So let's break that down. What do I mean by underlying?
The stock price or the stock.
Yeah, the stock price. So options, you have options prices. So it can get confusing if you're like, what are you talking about? Are you talking about the option price or are you talking about the stock price? So options are derivatives, what you call derivatives of stock. And so when you say the underlying price, that's what you're saying. So I'll read that definition again. A delta indicates how much an option price is expected to move or change for every dollar movement and the underlying price. So that sounds confusing, but go back to the Apple thing. It makes sense if you think about it from a share perspective. You buy one share of Apple, it goes up $1. What is your delta?
Repeat the question.
So you buy one share of Apple and it goes up $1.
Then that's $100 is your delta.
If you bought instead of 100 shares, you bought one share.
And it goes up $1.
Yeah.
Your delta one.
Your delta's 1. Does that make sense?
One check.
Even if we just spent time on this tonight, this will be really helpful. So you bought one share of Apple at $100. You have $100 in stock, right? The share price is $100. So you have one share, right? Forget the share for a second. What you really have is one delta, because if it moves up $1, you make $1. If it moves up another $1, you make another $1. It's never going to change. You always, for one share, have one delta. Does that make sense?
It does. I'm a little lost because you were saying that the share was $1 and now you're saying it's $100.
That's perfect. No, that's good. Let's stick with the 100 shares because that's easier. You bought 100 shares of Apple. So what is your delta?
This is normal. Bluetooth disconnect.
Sorry, could you repeat that? I can't
You
hear.
have
That's car navigation.
he hasn't stopped moving since 8.
It's just really about
Still quiet with this stressful.
Oh,
Like,
man, he's back to vertical.
it's like the Keanu Reeves. It's like speed. He has to keep moving.
The neighbor trying to park, I was in his spot, trying to move.
Oh, I got you.
You said the question. I said 100. You logged off because my headphones went to Bluetooth on my car.
Okay.
What did you say? Is that correct or not?
Yeah, it's 100. So 100 shares of Apple. You have 100 of it. The most you can ever make per dollar that it goes up is $100 per move up.
Does
that make sense?
Traditional stock market?
This is a stock. Yeah. If you bought a stock,
So you're saying the delta is 1?
stocks are always a delta of 1. And so the only way to get more
I see.
deltas and therefore make more money is to buy more deltas. Does that make sense? That's
I
why you
understand now.
that's why you have to have a bunch of shares to make money. And so that is a huge part of it. And so the thing that I'm about to say is the most confusing part, but what I'm going to try to do is present an analogy for what the options market is. Please stop me if it doesn't make any sense, or please just ask questions. But do you feel comfortable? I don't want anybody to be like, yeah, I got that. Like, I don't get that. You get what I'm saying about the stock thing. Like, you can only ever make $1 per share.
Yeah. It sounds like you're setting us up for the stock market is very simple, cut and dry, one for one. And the next part is like options allows you to break that rigid one for one structure.
I have set you up. That is exactly what I'm about to say. That's right. It's not that the stock market, less people on YouTube think that I'm like, he doesn't know about anything about the stock market. The stock market is complicated, but the pricing of the stock market is not complicated. How you price it.
Like supply and demand at the most basic level.
Yeah. And you have a fixed amount. The amount of shares you have is the amount of money you'll make or lose if it goes up or down. Now I've been racking my brain and I thought, should I use a football analogy? What should I use? And go with a car analogy. Here's the analogy. Yeah. So the option market is like a strange car insurance market. Okay. That's my thesis. The option market is like a strange car insurance market. Okay, here we go. So imagine a town where people love to bet on the future value of cars. Can you envision that? Can you imagine that town? Okay. And there's a whole industry built around this type of car insurance, but it's not the normal kind of insurance. It's speculative car insurance. Okay. Does that make sense so far? Do you imagine that world?
I can, but insurance is like only comes into play if you get into a wreck, really, or to protect. Okay.
I'm not trying to, that doesn't mean stop.
What?
Like, it looked like I just stopped talking. Stop saying it. So that's correct. It is car insurance. It's just weird car insurance. So what do I mean by that? So number one, the car in this analogy equals stock. Okay. So each car represents a company stock, or each car company represents a company stock. So let's say Tesla. Are you familiar with Tesla?
Of course.
Is that the one with the autopilot?
So let's say a Tesla, you have a Tesla. Okay. Just a weird world. You love America. You want to make America great again. You have a Tesla. Just imagine. And you sit it in your driveway and it can go up in value. It can get in a wreck. It can drop in price, right? It can lose value the longer you sit for, just decays, whatever. So cars are the stocks. It's the underlying. It's the actual thing, right? Okay. But then you have this weird car insurance. So you have people who say, okay, I've got this Tesla. If something happens to my car I actually want to be able to sell it at a determined price ahead of time. Like I'm willing to lose $20,000 on it, but I'm not willing to lose $40,000 on it. So they have the option to buy what's called a put. Are you familiar with puts and calls? We're now jumping in. So you're buying a put. And what does that put? You have a Tesla and you're saying, if the Tesla drops at a certain price, I want a contract that says I can sell it at that price, even if it continues dropping. So your Tesla got decimated, but you have a contract that says I can sell the Tesla for $20,000, even if it goes to zero, and you pay a premium for that. Does that make sense so far? So you're willing to pay that premium.
Can you explain the significance of the premium?
Someone's willing to take the risk to sell you that contract because your car's probably not going to go to zero. And so they are willing to sell you that contract to say, okay, I'll buy your car at $20,000, even if it goes to zero, because I don't think that's going to happen. And because I'm taking that risk, you're going to pay me a premium, like an insurance premium of $1,000 a year to take that risk on, or $5,000 a year or something ridiculous. Does that make sense?
The individual who owns the car has to pay the premium?
Yes. If they, so far in this scenario, you own the car, you want to protect it, you don't want it to go to zero, so you pay a premium for the chance to sell it if it goes below a certain value.
Within a year, which is the contract.
Yeah, say the contract lasts a year, and then you can do that over and over again. So let's flip the buying side. You buy a call. What are you doing?
Okay, hold on.
Oh, please. Yeah.
So you sold a put. Let's say I'm the Cybertruck owner and am I selling, so I want to take out the insurance policy. Am I selling a put?
Or are you buying a put?
If you're the Cybertruck owner,
Yeah.
you're buying a put if you want protection to the downside.
Okay. I'm buying a put from the insurance company.
Yeah. You were in that contract is this is important basically, because you're saying at that price, I own contract that says the price at my Cybertruck right now is $60,000, but if it goes below $30,000, I can sell my Cybertruck for $30,000.
A put is the right to sell.
If this is where it gets confusing, and this is where we'll just spend time on this tonight. It's your right to sell if you own that put, if you've bought that put and have not sold that put.
Okay.
So think about it like like you bought that contract, and when it's time, if you need that again, you'll sell that contract for the right to do it. Does that make sense?
But I can sell it at any point during that year.
Yes, but let's keep it in it. Yes, but I'm describing what options were meant to do in their original form,
okay,
and not what people have done with them. We'll talk about that in a second.
Gotcha.
But the idea was to say, let's go back to Apple. I own Apple 100 shares at $100. I bought an 80 strike put. Strike is the price of the contract where the contract takes effect. So Apple's at 100 right now. I bought a put at 80. And basically that means I'm willing to lose $200 or more if you keep buying the premium, but let's not get confused. You buy the contract. You said, if Apple crashed down to $10, I can sell my contract and sell my stock at $80, even though the price is $10, right? That's what it was originally made for. Does that make sense? And how you do that in your brokerage, you would literally, it's called exercising an option. You would alert your broker and say, I want to exercise this option I have on my stock. And basically they would put your stock as if you sold it at $80.
And in the original purpose for options, essentially, it's like you said, it was protection against your stock completely losing value. And when you say you would exercise your option, that's in the original like creation of options, you would exercise that option at the end of your 1-year contract.
At the end of the 1-year contract, but not necessarily at the end. So if you owned a 1-year contract that says anytime in the next year, I can exercise this option if the stock price has dropped below the threshold. So it's an 80 strike contract.
Gotcha.
Let's say, I don't remember what Apple did, but let's say it did. But let's say it dropped 50% from Liberation Day. It was 100, suddenly tariffs, it's down to 50. If you owned 80 strike put, even though it would expire in a year, you have a year basically, as long as it's in what they call in the money. The price of the stock has gone past that strike price on the put. You can exercise that option and get out. That's what it was meant to. So that's the put side, buying a put. Does that make sense?
And you've paid a premium for that contract.
That's correct. That's exactly right. You were willing to pay a premium.
When you write that contract, because are you the one who writes that contract?
There, in today's world, it's a built-in kind of like auction.
Sure.
Where you click a button and you own that contract.
Do you have to own the underlying stock first?
Absolutely not. We're going to talk about that in a second. That's why this is a weird insurance market.
So I could get out with 100 stocks of Apple at $80.
Even though you don't own the stock.
Even though I don't own the stock. Would I actually have the stock?
No.
I would just
not for the buying put. We're about to talk about a scenario where you would own the stock.
Okay, so for buying put, I would just have $80 of Apple or whatever.
So that's put buying. Does that make sense? In a traditional sense, forget the speculation part. Let's just pretend there's a world that's the 1950s. You own a Cybertruck. So people think you're an alien. And okay. Yes.
And if it doesn't go below that value, you use out the premium.
Exactly. It's just like insurance in that sense.
Okay.
You pay insurance every month and they just collect that money every month.
Okay.
Until your roof breaks. So now that's the put side, owning it. Now let's talk about buying a call option. So there's puts and calls. So let's say you didn't own a Cybertruck, but you wanted to own a Cybertruck and you actually thought that you could get a deal by taking a risk and buying premium. So let's say the Cybertruck is $100,000 right now, but you actually think it's going to be worth $200,000 in a year. Okay. You could buy a call option that expires in a year at, to make it super easy. Let's say instead of $100,000, it's $100. The Cybertruck costs $100 and it's going to $200 in a year. You could buy a call option that expires in a year for $100. Okay. This is where we'll talk about the graphs and all this stuff because you have to minus the premium when you're considering this stuff because there was a cost to owning the premium. Right. But basically what you're saying is if it goes past $100 within a year, at any point, I could exercise that option and you will put a Cybertruck in my driveway for the price of $100 minus the premium. Does that make sense?
Yeah.
So that's like for those who want to buy a stock, but they don't want to just buy the shares. They don't want to just buy deltas. They want to buy something more than deltas. So buying a put is a right to sell. Buying a call is the right to buy.
Brilliant. I wish I came up with that.
That's buying options. Okay. Now here's the fun part. The majority of people in today's world sell options. Okay. So what is selling an option? Let's switch it for a second. And instead of Cybertrucks now, let's talk about Hummers. So let's say you have someone, this is where it's about to get confusing, okay? Because I talked about buying a car, and that's the right to buy. But there's another way you could actually buy a car or buy a Hummer. Let's say in your friend's driveway, they have a Hummer that you like. And you say to yourself, I'm not going to just buy it and waste premium every year if it doesn't go up. I want to be a little smarter. I can be the insurance company. I'm going to sell them protection. I'm going to tell them, listen, for a specific amount of money for a year, we'll write up a contract. And if the value of your Hummer stays above, let's say the Hummer's $100. If the value of the Hummer stays above 80, I get to collect that premium. You keep your Hummer, right? It's all good. I'm willing to take that risk of just collecting the premium. And let's say for a couple of years, you just collect premium. The value of the Hummer just stays well. They don't drive it. It's just sitting still at $100. Let's say the third year of collecting premium, suddenly something happens to the Hummer and the Hummer has dropped to $50. Okay. You have made a promise in that contract to buy this Hummer from that person if it goes below 80 at the price of $80. Does that make sense? So what they're going to do is when they exercise their option, they bought that put, they're going to come to you and be like, price is down. I want to sell it at 80. And you're going to say, this is where options get really interesting. Depending on how many times you remember before with stock, deltas, shares, it's static. Like it goes up, so it goes down. Options are weird in the sense of you say, I don't think a Hummer's worth $100 right now. I actually think it's worth 70, but I'm willing to collect premium for a while and then buy it at 80 because I think it'll go up. I think it's going to go to 200 in the next 5 years. So I'm willing to take a risk that it goes down, buy it at a specific thing, plus the premium that I've received. And now I own it at 80. It bounces back up. I'm a genius. Does that make sense at all? And so a lot of times what happens is you collect that premium over and over and over again. Really after the premium, maybe your price isn't 80. Maybe once you take into account the premium, maybe your price is like 50. So you're actually doing ahead. You're right where it should be. So you're great. You're like, I got it for $50. That's great. That's where I want to be. I actually think it's not going lower than 50.
With the premium, you're pricing in a potential loss perhaps, or you're hedging a little bit with the premium that you charge.
Yeah.
So you're stacking up your premiums for that one time. You need to, I guess I am lost. You're stacking up your premiums so that when you actually have to follow through with the contract, you're not behind.
Yeah, you're like insurance in the sense of I'm willing to pay you $15,000 if your roof breaks, because I think by the time you're done, you're going to pay me $50,000.
Yeah,
for your roof not to break, and that's my risk. So you say most of the time, I think it's going to go to 50. Every once in a while, it might go to 10, and I'm screwed in that sense. But I'm doing this all the time, so that's a risk I'm taking because I'm collecting. So it's classic insurance in that way.
You have to now do you have to actually own anything in this scenario?
No, you don't own anything yet. You might be assigned. We'll talk about assignment, all this stuff. But because eventually the goal is to get you guys trading if you want to trade. And so we'll have to talk about assignment because options are leveraged, things can happen in your account that you don't want to happen. You don't have to have the money in the account for things that happen that you don't want to happen. That's the leverage of options. So anyway, but yeah. Seth, just off the top of your head, would you rather sell that put or buy that put? Would you rather sell that put or buy that call?
As far as your explanation of those things, what would I prefer to do because of how it worked in my head?
Yeah.
Is that what you're asking?
Yeah.
Which specific scenario are you talking about?
In both the buying a call and selling a put, those could both be scenarios where you actually want that car. But they're very different means in which you get it. Remember, buying the call means you're buying it at a certain price, hoping that the value of that call goes up and you can buy the car for the price that you have.
Yeah.
Does that make sense? Or you're selling a put and you're saying, I'm willing to buy it if it drops below this round position.
I feel it. The way it sounds to me, it sounds like selling is not as much gain potentially, but more likely to happen, I reckon, for you. Whereas buying would be the opposite.
That's
So-
exactly right.
I think in an ideal world, I would do both. I don't, it all seems like odds to me. And I think you want to play the odds, but I hope through this course, I can learn how to do both of them.
It's not a course, but thank you. My
She's
goal is-
describing hedging.
Please, that's actually, if you sell a put and buy a call, that's like the ultimate bullish meaning you think it's going to go up move. Because you're actually, we'll talk about this later. You have a huge amount of risk in that.
Ask one question real quick.
Please.
I feel like if you were to buy a put compared to selling a call, you need to be much more in tune to news. Is that correct? Or the news itself?
News is definitely important. We'll talk about news. It depends on what you're doing, what underlying you're doing. So if you're
Well, that would be the determining factor. If I was to sell a put or sell a put.
Yeah. Some moron,
Yeah.
liberation day before the market closed, probably sold what's called a naked put, which don't even worry about that. Just say he sold a put saying, oh, Trump's going to do what Trump does. Like market will be up by Friday. Like they weren't happy. That didn't work out.
Yeah.
Good. There's an immense amount of risk.
Say the market will be down.
You could have bought a put and you were very happy because you got,
Okay.
let's say in this world, let's just stay real without the speculation part. It's the 1950s and everybody actually owns their cars that we're talking about. If the president came out and said, all your cars suck at noon today, we're going to burn all your cars. Everybody who owned puts were very pleased with themselves that they owned puts. And everybody that had sold puts were very sad, right? Everyone who had bought calls thinking the value was going to go up was very sad. Now let's do the last part. Everyone who had sold calls was very happy. Now selling a call is the thing we haven't talked about. If you're buying a call, again, meaning the price is 100, I'm going to buy $100 call that expires a year from now. And I think we're going to double. So if it goes to 200, I'm going to exercise this and I get to have shares in my account for a car in my driveway for the price of $100 plus the premium I paid. That's now worth $200 right off the bat. Flip that. Someone sold that contract to you. Why did they sell it? Because they said, I'll collect that premium like when I'm selling puts, because I actually don't think the car is going to gain that much value in a year. I think it's going to stay put or it's going to go less in a year. So on Liberation Day, everybody that had sold calls did not think the stock market was going to go up. They thought it was going to stay the same or go down, and they were very happy. So Liberation Day is such a binary event that it's actually helpful to think through it. Everyone who owned the put or had sold a call going down was happy. everybody who had bought a call or sold a put was unhappy. Does that make sense at all?
I have to think that there's 4 ways it could go. And it's the concept, but it gets garbled still a little bit.
Quick question. Sorry. Jeremy Parker.
Thank you.
Would you say the majority statistically of options traders sell calls? Or is
If they own the stock, right?
is it pretty evenly split?
Great question. Thank you for asking. It's not, the answer is, there's a Bloomberg article that just came out that talks about this. Basically, everybody's guessing. Everyone's selling puts. That's what everybody guesses. There's a reason for that, but everybody's selling puts. Now, what if you had to guess out of those 4, you think about the stock market as a whole, why would most people sell puts out of those 4 options? There's a lot more options than that, but that's the basic, that's the engine of the options market. Why would most people sell a put?
Is it because the market typically goes up?
Yeah.
By default?
Yeah. But if it typically goes up, why wouldn't you just buy a call?
Yeah. Because you also get the premium?
Exactly. That's right. That's exactly right. Most people are selling puts because they are collecting income for the market to do what it just does naturally, which is just slowly goes up over time.
Yeah.
So in this weird options insurance world that we're talking about, the car insurance market that we're talking about, the pretend one, in this town that we live in, people can, to answer the questions when asked earlier, people can buy and resell the car insurance policies without ever owning in our world. Okay. So Bob could buy insurance on Jeremy's Tesla. And the next day Tesla news drops and the chance of a crash goes up. And because of that, we'll introduce this later, the policy is actually going to go up in price, even if the market hasn't tanked. So there's something else. So that statement in of itself is a big deal, because in stock land, you only can ever make $1 per share, the thing we've hit home. In options market, there's actually a lot of pricing that's happening besides delta. And that's why options get super common. We'll talk about the Greeks next week. They're called the Greeks, in that stocks have one metric. If you're plugging in a formula for how stocks make money or lose money, there's one plug-in, which is delta, right? So you've got 100 shares, $100 per share, $1,000 per share. In options, there's 5 inputs that affect the pricing of it. So it gets really complicated. But just for that example, Tesla news comes out in our small town. Bob owns the put, and the premium has gone up on his insurance policy, even though the car value hasn't dropped. So the people aren't just insuring to protect anymore. They're trading on the insurance itself. Does that make sense? Okay. Just to continue, every policy has an expiration date, and after that, it's worthless. Like we've talked about that. The policy only covers your Tesla for the end of the year, or the end of the month, or the end of the week, or the end of the day at this point, right? And so there's policies that are expiring all the time. Does that make sense?
Yeah.
Okay. And then the contract is, the strike price in the contract is like the deductible kind of. It's like the threshold. So again, to use that example of the put, your Tesla's worth $100. You bought a put at 80. It has to get to 80 or below for you to be able to exercise that option. But remember,
But 80 is not the strike price, right?
strike price is 80. So say the current price right now is 100. The strike price for this contract is 80. But remember, in our world of crazy small town, weird insurance, you can trade this policy without it ever getting below 80. You could trade this policy if it got to 90.
Where would the money come in?
How would you make money from it?
Or yeah, how would you make money on that?
Because that's a good question. So let's say the put is the Tesla is $100. You bought the $80 put, right? Let's say it went from $100 to $90. Your policy is worth more now because you're that much closer to being able to get it. And so the value has gone up because
Like
of
the premium.
premiums have gone up because of the option Greeks that we've been talking about.
That makes sense. Would the strike price still be the same? You're just selling it at a higher premium?
Exactly. You could sell that 80 strike contract for more money now because it's closer to being able to get exercised.
And would the expiration date stay the same? You can't change that.
That contract would stay the same.
You're just trading hands. You're just like, it's out of my hands now.
Exactly. Exactly.
Like a hot potato.
It's just like a little hot potato. So to finish that thought, everyone in today's, to go back to the options market, everyone is insuring cars they don't own all day long. So I think I'd say that's pretty clear. Any other questions for tonight?
Yeah. Can you review puts and calls again?
Yeah.
Just very briefly.
So you buy a put. Now I'm going to move away now from assuming you own the car. And I'm just going to talk about what people do now, like how people actually trade the market. You buy a put if you think the market's going to go down. You sell a put if you think it's not going to go down below the price that you sell that strike at. Okay. The calls are, if you think the stock's going to go up, you buy a call. If you think the stock's going to stay the same or go down, you sell a call. So the final thing with that is buying a put or a call costs you money up front. Selling a put or a call, you get money up front, but with the risk of it being. And this is the final thing with that. So selling a put, what's the max? So Apple, you buy 100 shares, you've cost $10,000. It's $100. How much can you lose?
$10,000.
$10,000. It could go to zero, right? So basically saying when you sell a put naked, meaning you don't buy any protection just underneath that. We'll look at that next week.
Yeah.
You are risking it going to zero.
Okay.
If you don't buy that back for whatever price, that contract could go to zero and you're assigned something worth zero at a price of $80.
Yeah.
So you buy a put, what's the most you could lose? Let's say Apple's at 100 and you buy an 80 strike put for $100, a contract for $100. What's the most you could lose?
$100?
That's right. When you buy the premium, the contract price is what you could lose. So flip that. You buy a call for $100. What's the most you could lose?
$100.
$100. You sell a contract, you sell a call for $100.
Yeah.
How much could you lose?
Everything.
It's undefined. It's undefined.
Yeah.
The stock price could go to $1 million. And you are financially liable for that.
Yeah.
Does that make sense?
And that's if you sell a call.
Yep.
So is that the riskiest of all of them?
Yeah.
But if you sell a call, you can put more stipulations into it, protect yourself.
So there's ways to protect yourself on both sides. And we'll get into it next week. This is where options get crazy. And this is the beauty of options. So the way we've talked about it, it's been up or down. You sell a call, you think it's going to be put, that's not the right one in the sport. You sell a call, you think it's going to be sitting still or it's going to go down, right? It's capped. You're selling a call and you're like, it could go up to there or be below here and I make money. You sell a put, you're saying it could go down to here or be up here, I make money. But then people, what they'll do to hedge their risk, to make it a defined risk spread instead of an undefined risk is you'll sell a call, but then you'll buy a call at a strike price above that. That's called a spread, an option spread.
And I remember on your software that you showed me, that's where the strategy is, right?
That's right.
It's like that spread so that it's more defined.
That's right. So you can sell a spread and you say, I'm at that point, let's say I'm risking $400 to make $100. It's still the risk reward. You're trading probability. It's probably not going to happen, but I'm risking 400 to make 100. Put side, same thing. I'm selling a put and then buying a put below that, making it a spread. So I'm risking 100 to make 100. Options are crazy. You can flip that. You can say, I'm going to buy a call and then sell a call above that. So I'm risking 100 to make 400.
Can you do all four?
Or, and this is the beauty, this is my favorite thing about options. Again, that's why I started with the Apple thing with the delta. The delta is static. It either goes up or down, right? You don't make money. If you own 100 shares of Apple at $100 and Apple stays at $100 for a year, you haven't made any money. The stock has to move to make money. In options, you can say, I want to make money even if Apple doesn't do anything. How do you do that? You can sell a put and sell a call together, which is called a strangle. Or you can sell a call and sell a put, and then buy a put and buy a call past that, making it defined risk. And that's called an iron condor. So we'll talk about all those strategies in future weeks.
It is the ultimate scheme, is what you're saying.
I want to be careful what we're saying. It is
That you're right. You're absolutely right.
It is the ultimate schematic. Now understand what I'm saying when I say that.
Okay.
Okay.
Yeah, I get it.
All right.
We're on the same page.